Now, for more on the change of leadership at the Federal Reserve and U.S. monetary policy, we're joined by Victoria Guida. She's a financial services reporter for the news website Politico. Welcome, Victoria.
Thank you.
So let's start with this changing of the guard, as it were. How would you compare Yellen and Powell's leadership styles?
That's a great question. It's not entirely clear how his style will be different. One thing that's obvious from the outset is that Powell has business experience, and so he thinks of things in a much more practical perspective in terms of signals of what he's hearing from the business community as opposed to what theories and models tell him. So in terms of direction and what he'll look to, that'll be quite a change.
Now, we know that on the plus side, Powell is coming in at a time when the economy is strengthening, you have a stock market that's been soaring, unemployment at the 17-year record low. But on the flip side then, how does he sustain that, given the fact that we know that the bond buying program is going to start being waned away, and then also these interest rate increases that we know are coming on the horizon?
Right. It's an extremely tricky balance for him because, a recession, it becomes more and more likely the longer that the expansion continues. He has to make sure that he doesn't raise interest rates too fast and cause a recession. But then if he waits too long to raise interest rates, then inflation can start to move out of control, which would then require the Fed to raise rates faster, and that could cause a recession too. So it's a very, very tricky balance. And so in some ways, it's, perhaps even more complicated than what Chair Yellen had to do because, it sort of became clear when rates really did need to start rising. But the question of when to stop is also going to be very difficult.
And we know that the Fed had its eye on this stubbornly low inflation rate. What are some of the other headwinds that you think we should be keeping an eye on?
So, yeah, as you said, inflation is the biggest thing that they're watching. Wages have sort of started to rise, and that will be a big indicator as to, whether inflation really will move up toward the Fed's 2% target. Also, as rates rise, that could reveal some bubbles in the stock market, as we were just hearing about, and anywhere else where there could be, potential financial stability concerns. And so the question is really whether the Fed needs to keep raising rates, not only to guard against inflation, but also to make sure that those financial stability concerns don't continue to rise.
Now, we know that central banks around the world really had to take some drastic measures given the global financial crisis. So in terms of global headwinds that other central bankers are looking at, what's keeping them up at night, you think?
Great question. So the European Central Bank has a lot of different things that they're having to keep an eye on because, they're still buying bonds in pretty large numbers. They recently lowered it to $30 billion per month, and that's going to continue until September. And one of the things that's really going to affect that is whether the euro continues to be a little bit stronger than they would like to see. In terms of, the Bank of England, Brexit is still a drag on economic growth, but inflation is also high. So that's, one of the main factors. The Bank of England could raise rates up to 2 times this year, but, they might not raise it at all. Right. So they've got a bunch of things they're watching. The Bank of Japan, there's going to be potentially a leadership change. It's unclear whether Governor Kuroda is going to continue. And that will really determine whether the Bank of Japan continues to try and really aggressively try and reach their 2% inflation target, or whether someone else might come in and kind of rejigger those expectations.
And just very quickly, in terms of the tools that are left in the toolbox, with rates still being pretty low around the world in terms of interest rates, how prepared do you think a lot of these central banks are for the next potential global shock?
So that is a huge concern. I mean, the Fed here, interest rates are still fairly low, only between 1.25% and 1.5%. So they only have so much room to continue to lower rates. I think that they would say they have some room, but it's definitely an open question whether they really have that much, because it's still, you know, as you were saying, all of the global banks are still stimulating the economies.
Right. Well, thank you so much. Certainly a lot to watch for. Victoria Guida there of Politico.